Hi, I'm Steven Van Metre, and welcome to your Wednesday night premiere, where we take about 15 minutes every Monday and Wednesday night to try to make sense of markets. Still aren't making any sense at all. But the big news today is the Federal Reserve, who met to discuss monetary policy. And the group that does that is called the Federal Open Market Committee, or FOMC. And they do not meet every month, but they meet almost every month out of the year. I want to say about 9 of them or so they do meet. And they use these meetings to not only change policy tool, but to provide what's called forward guidance or outlook to say, though, this is kind of the path we're headed on. Now, of course, it doesn't actually mean they're going to do what they say they're going to do. In fact, I recently read a paper presented at a presentation at the Chicago Fed here a couple weeks ago. And in the paper, they talked about these forward guidances, how they were wonderful tools to tell people what you're effectively not going to do. You can use them to squash investor concerns and do all kinds of things, but it doesn't matter because what you end up doing in the months of fall have no bearing on what you said previously, which is really cool. Now, the other interesting thing, and we'll look into what the decisions today that were made by the Fed, is that I was actually right. The content of this video is provided as educational information only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by or selling a security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity and opinions expressed in the video that anyone do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So what did I predict there would be? No rate cut, and there wasn't. The Fed decided to hold the federal funds rate between 2.25 and 2.5%. And this makes sense because even the Fed said, look, the economic data is not that bad. In fact, the only problem the Fed actually has is that inflation or consumer prices, what you and I pay, that we know are going up, but in the Fed's eyes, it's like blurry, blur vision. They can't really see it. They're not going up as fast as the Fed would like. And the Fed is targeting about 2%. And we're sitting at roughly 1.5% using what's called the core PCE. They do not use, although they do look at producer prices and consumer price indexes, but they have something they call the core PCE is what they use to gauge inflation, and it's running under 2%. So what a lot of investors thought in this going to this meeting today is that the Fed needed to ease and actually lower interest rates today, and which of course would then naturally drive stock prices higher. At least that's the view of stock investors today, is if Fed eases, stock prices go higher, and that's great because I'm leveraged to the hilt. Not me personally, but in general, how most investors are. And when you look at the stock market right now, it's in an 18-month topping pattern. Yes, it's kind of a little higher than it was 18 months ago. Effectively, it is flat for 18 months. And you'll hear me say that. But there's a problem with that because there are people that have leveraged positions. And when you take a leveraged position, there's a upkeep cost to it that you have to pay on a periodic basis to hold that position. And some people are leveraged by borrowing money to buy stocks. Well, there's an interest cost every month. And so these people that had a price target of, well, the market needs to go up to here somewhere. Well, they're not hitting their targets, but their costs are eating into their profit margin. Now, at some point, they either will sell or the market's got to go higher so they can sell and hit their targets. But it keeps looking like the market's going lower because it's not going higher. You think about it, if a market does not make new highs, at some point the assumption has to be made that there isn't interest in taking it to new highs, and then it has to go down to find where buyers are at. So why are investors calling for a rate hike? Well, rate cut, is one, they wanted more liquidity to be created to push stock prices higher. Number two, the underlying plumbing of the market is clogged up. And this is that NASDAQ McClellan Summation Index that we like to look at almost every video that we do. Because with stocks nearly back at their all-time high, the index is not moving higher. So this is saying that something is jammed up in the plumbing and the liquidity is weak, and the net likely direction, maybe not tomorrow or Friday or Monday next week, the likely direction for stock prices is lower, is what this is saying. Because when this index breaks zero, and it's been sitting between minus 200 and minus 300 for the last week, it usually says there's plumbing problems with the market. There's liquidity issues. Now, what we would expect if the market was back near its all-time highs like it is now, it should be up here somewhere. And it's not. It has not budged. So it's telling us there is something very wrong. But the Fed did stand pat despite, and I don't know if this is fake news or not, that Donald Trump has looked into demoting Jerome Powell from Fed chair because he wants to use monetary policy to support his trade wars. And that is not what the Fed is intended to do. Of course, the Fed can't actually do their job properly, and they never have, but that is a story for, well, another day. So the Fed did maintain their data dependence. They also threw a cookie to the stock market. They said, well, and I'll show you, we're prepared to ease if we need to. And that's all investors wanted to hear. Of course, once investors hear that, they don't bother looking at anything else, but it's not what anyone really thinks. So let's take a look at here on a 12-month basis. Overall inflation for items other than food and energy are running below 2%. Okay, we know that. Market-based measures of inflation compensation have declined. Survey-based measures of long-term inflation expectations are little changed. So what they're saying is that, yeah, inflation isn't being our target, and people are starting to not believe that we are going to achieve it. So we'll go down here and see. So inflation near the committee's symmetric 2% objective as the most likely outcome. So they're talking about how they believe that things aren't as bad as everyone says. Of course, the Fed never does because their data is always 6 months old. You have to keep that in mind. They do not use real-time data. But uncertainties about this outlook have increased. In light of these uncertainties and muted inflation pressures, the committee will closely monitor the implications of incoming information for the economic outlook. So here's all they're saying, stock market. We're going to look at the data. That means we ain't going to do nothing. We're just going to look. And we'll act as appropriate to sustain the expansion. So all they said is, well, if we need to adjust monetary policy up or down, we will do that. But we're not telling you when or how much. With a strong labor market, inflation near symmetric 2% objective. So they're saying, look, we'll just adjust monetary policy as needed. But one thing you have to understand is because their data is 6 months old and they try to smooth out the fluctuations in data, they don't react right away. That's why they always make mistakes every time. And this time will be no different. All right, so let's see. In determining the timing and size of future adjustments to the target range for the federal funds rate, the committee will assess realized and expected economic conditions. So again, we're going to wait till the data comes in month after month relative to its maximum employment objective and symmetric 2% inflation objective. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures, inflation expectations, and readings on financial, aka stock market, and international developments. Translation, we'll be watching the tariffs. You see, the Fed knows, and this was one of their concerns, and they did not publicly say it, but it has to be. Imagine if there was a secret backdoor deal with China going on right now where we actually did have a deal. And I don't think so, because somebody would have likely leaked something somewhere along the line on both sides. But let's just pretend this whole thing was a big scam between President Trump and President Xi to get central banks to lower interest rates. Now, President Xi doesn't really need that because, well, they're a planned economy. They can just do whatever they want. But we aren't. So how do you get the Fed to lower interest rate? Well, simple. You just cause the economy to slow down. Then the Fed lowers. So let's say the Fed lowered 0.5%, and then bingo, in a week and a half, when President Trump and Xi meet in Osaka, boom, there's a new deal. Trade war's over, and bam, inflation expectations shoot. Guess what happens? The Fed's in a bad place. That is why they do not make monetary policy based on what the president or Congress is doing. They have to look at the data because they can't have their heads lopped off due to people trying to scam the Fed. That's what's going on. Now, you've seen the press release. Let's go look at the other thing. Now, everyone's talking about, oh, in July, there's going to be a rate cut. Okay, there might be, but let's look at what the Fed actually said, not what the news is telling you. So here you have core PCE inflation target in 2019, 1.8. It's at 1.5. So the Fed still thinks by the end of the year this is going to rise. And true enough, if the tariffs are pulled off, even though it is backwards, that should work. you got to keep in mind there's a lot of inventory buildup. That's why there is downward pressure on price right now. 2020, they think that core PC is going to get to 1.9, and by 2021, they're going to hit their target. And they're saying their March projections were off. Right, we know that. Now let's go down and look at the federal funds rate projections. In March, they projected a 2.4, which is where it's at now. If you average between 2.25 and 2.5, you get this 2.4 number rounded up. So in 2019, they expect to keep the federal funds rate, guess what? Right where it is now. See, this is what I want you to understand. The Fed uses these meetings because press releases and all this stuff because they know people don't read it. It's right on their website. I should pull right off their website. I mean, it's right here, federalreserve.gov. It's right, printed right today. Now, in 2020, they're concerned potentially that inflation may need a little juice. So they're saying, we think in 2020, we might lower the federal funds rate, even though in March, we thought we would be raising it. And then 2021, we're projecting that we'll be back right where we are now. And in the longer run, we plan to increase it a little bit more in going forward. So there you have it. The Fed doesn't want to cut rates. They just want you to think they're going to cut rates. And all that means from monetary policy is, one, that means gold should go down. Interest rates should go down. Treasury bond prices should go up. Now, when I say bonds, I generally always mean treasuries unless I say otherwise. So when I say bonds, referring to treasuries. And due to the lags in monetary policy, this should be bearish for stock prices. And when you look, so when you take the two, the monetary lags, and you add it, I got to do this backwards, and you add it when you look at the NASDAQ summation chart and you start thinking, oh, liquidity, the plumbing in the market's backed up. What does that tell you? That asset prices need to fall due to the Fed tightening monetary policy. That's how it works. And the markets are feeling the lack of liquidity. They're trying to drive stock prices higher. And what is their intended outcome from this? Very simple. They want all these people that bought treasury bonds over the last, 6-9 months, to sell them. Because think about it. Let's say I've got $1 billion worth of treasury bonds, right? I'm a big time money manager. I got $1 billion worth of treasury bonds. And I sell them. Now, what am I getting for that? Cash. And where am I going to go if I don't want bonds? I'm going to buy stocks. That's what stock investors are seeing. See, they're seeing this big divergence between stock prices and bond prices, and they're thinking, oh man, if we could get all those people to sell those bonds that they bought and put it in the market, boo, we're going to go to 3,200 on the S&P or higher. That's what they want, and they're not getting it. And people don't understand. That's why I show you the big banks, big commercial banks are buying. That's why we looked and saw last month, even though there was a net sale in foreign-owned treasury holdings, they were, of what they did keep, they were dumping their short-term bonds to buy long-term bonds. Let's look at some charts. And let's look at that divergence between the S&P 500 and 10-year treasury yields. This is the focus right now. And I can tell you the 10-year treasury yields are in the right place. And the risk we have is that stocks are going to hit past their December lows. So stock investors are saying, we need you to sell. And bond investors are saying, we need you stock investors to sell. That's what this is saying. Because treasury yields and stock prices generally do not diverge, and this is one of the largest divergences I could find. I mean, it is huge. These normally correct. So the one goes down or the other goes up. It's rare that they meet in the middle, and the reality is due to who is buying the bonds, and this is important, who is buying them, the smart money, commercial banks, and foreign investors. Foreign investors know a lot more about our economy than we do because they experienced the lags first. They all know that it's only a matter of time before stock prices head down. And when you understand that we are headed, oh shoot, you can't see any of that. Here you go. Sorry about that. Here's the divergence between stock and bond prices. But when you see this big divergence, and you know what's going on in the global economy, and what have you got coming up? The G20 meeting, which is going to be no trade deal, most likely, because they would have one by now or something in place. Number two, you've got second quarter earnings coming out, which probably won't look that great. And why is the market up? Because corporations are trying to jam as much of their money back into stocks so they can show investors, look, we hit our price to earnings target. Even though we may not have sold that much more, maybe we sold less, but don't worry, we bought enough of our stock back to make things right. In the end of the day, liquidity is drying up, the bond market is right, and they're going to pull the stock market down. Now, from an investment standpoint, what we're looking at is making an allocation adjustment to the portfolios to pick up some longer bonds, and don't have a lot of time, but I'm thinking that there'll be a little bit of rebound in here as sellers try to force liquidity into the market. That'll be a chance to rebalance some portfolios, because where is this thing headed? Oh, a lot lower. It is headed back down to here. See, we're hitting this one of these big waterfall moves. Based on my numbers, you get about a 1.5% drop in yields. That's telling us 30-year treasuries are headed to new all-time lows, and there's a lot of money to be made in long-term treasuries, hence why the smart money's buying. I'm Steve Van Metre. See you Friday. See you Friday.